All right. We got some breaking news here from the Finra Board of Governors. They had their meeting just this past week, and it looks like they voted to approve the amendments for the pattern day trading rule. This is big, especially for the beginner day traders. The beginner day traders now do not need $25,000 to bypass the pattern day trading rule. They are not limited to 3 trades in a 5-day rolling period, something that I struggled with for so long. And they may not necessarily need to be on a cash account to be able to trade an infinite amount of times up until your cash balance. So let's take a look at this article. Well, I guess it's not really an article, it's a news release on the finra.org, the official website for Finra. Finra is one of the regulatory agencies in this industry. Also, another regulatory agency is the SEC, and the pattern day trading rule proposal needs to be approved on both Finra and the SEC. So right now, so far, it's only been approved by Finra, and it does need to get approved by the SEC for it to move forward. So let's take a look here at this article and see exactly what they say. I can scroll right down into the meat, of this little news release, and it's very vague. I wish it gave a little bit more detail, but it's very vague. But I can show you guys the meat of this article or this news release. So the board approved amendments that will replace the day trading and pattern day trading rule, including the minimum equity of $25,000 for pattern day traders and they're going to replace it with an intraday margin rule that applies the existing maintenance margin rules to intraday exposure. So this is probably the most important line of this entire news release, because they approved to replace it. They're going to replace the $25,000 pattern day trading rule. Given that it is approved by SEC as well, it needs to get approved by the SEC. But Finra is all on board with changing this. And there's been a lot of proposals over the last few years of getting this changed. So it looks like they're finally starting to make some changes. And usually, big industries like this, it takes a very, very, very long time for things to actually change. And the PDT rule has been around for 25 plus years. So the main argument is that now with our sophisticated technologies, way 10 times, 100 times, 1,000 times better than it was 25 years ago. All right, so if we look at this a little closer, it says it's going to replace the day trading pattern day trading rules with an intraday margin rule that applies. They're going to apply the existing maintenance margin rules, which is usually 25% maintenance. So during intraday, maybe up to 4 times leverage on certain brokers. A lot of brokers increase the maintenance because they don't want traders trading on 4 times leverage unless they're very, very experienced or they're approved, especially approved by the broker. So most of the times it's maybe more around 50% maintenance, so maybe only 2 times leverage. And then also overnight there's Reg T, so Reg T being only max of 2 times buying power for overnight. So I think what this means is just going to apply those rules to the accounts that are trading on margin under 25K. And the other thing, so they're just going to apply that to intraday exposure. So the other thing that we don't know about yet, so if they're just going to apply the margin rules that are above 25K to the accounts that are under 25K, and pretty much taking away the limitations of the 3 trades per 5-day rolling period, which will be big in and of itself. I mean, for small cap traders, we don't really need margin. Most of the stocks that I trade anyways, you cannot even trade on margin. Like, the broker doesn't allow you to trade these small cap volatile stocks on margin no matter if you're experienced or a beginner. Because the stocks are so volatile, they can move 20, 30, 50% in minutes. In a minute, in one candle, you can see a stock go 100%. It's so volatile that you just can't get margin. So with the strategy I trade, the margin requirements doesn't really come into play because we don't use margin anyways. The only thing that does come into play is that settlement margin. That settlement margin will be big because if we can get settlement margin on accounts under 25K, that will make so much more volume in the markets. Now you'll be able to get the average Joe working at Wendy's on that Wendy's wage to be trading hyper scalping small cap stocks with $2,000 of Wendy's money in his account. That will be big. And there's a lot of people that want to trade, but they don't have that 25K. So they can't trade. They can't reasonably grow a small account, and they obviously cannot trade under a PDT account, because if they have under 25K, they can only trade 3 times in a 5-day rolling period. And if you're trading small cap stocks, that's just not going to be good enough. Like the thing about small cap stocks is that you need a lot of iterations, you need a lot of trades to get the edge. It's really hard to get the edge with 3 trades in 1 week. Maybe you can do that with large caps because you're buying and maybe you're holding for a couple of days, maybe like a small little position throughout the entire day, holding the entire day, riding the trend, the quote, the trend is your friend. So, sometimes you got to be very, very patient with that trade. So maybe you can get away with that. But with small caps, you need a lot of trades to capture the edge. So that doesn't make it feasible for most traders, especially people who don't have the 25K. So if they have a few $1,000s and now they can trade that settlement margin, that will be big. That will be big. It's going to bring a lot of volume in the markets, and we're going to be getting massive moves. Like we were seeing in 2020, 2021, moves like that. I think we're going to see moves like that on a regular basis. This year it's been really slow. We haven't been seeing crazy moves because I think it's because of the interest rates going up higher, and people just don't have that money to trade like they did in 2021 and 2020. So, in 2020 we all know, people were getting these stimmy checks for $500, $1,000, $2,000 stimmy checks, and they're thinking, all right, free money. How do I double this? How do I 10x this money? Let's throw it in Bitcoin. Let's throw it in some crazy small cap stock that's going to go to 300% every single day. That was happening. And I think it's going to happen again when we do see these barriers start to drop in this industry. All right, so I plugged this phrase into the Chat GPT. They replaced the PDT rule with an intraday margin rule that applies the existing maintenance margin rules to intraday exposure. What does that mean? So the old rule, we all know the old rule. The new rule looks like they say it's going to be ongoing equity. You must have relative to your positions, often 25% for stocks under Reg T, but brokers often require more, closer to 50%. So ChatGPT is saying they're just going to apply those rules to the accounts that are under 25K. And then I ask, what about settlement margin? That's going to be big. That will be big. This is probably the most important one for at least small cap traders. And so settlement margin under the new Finra rule, it says, ChatGPT says, since Finra wants to drop the 25K PDT threshold with an intraday margin system, they'll also need to account for settlement risk. That means if you're trading rapidly, your broker may still reserve part of your equity as settlement margin until trades clear. That will be bad. Your intraday buying power could be limited not just by Reg T and maintenance, but also by how much unsettled activity you have pending. So we're still not sure if we'll be able to trade, let's say, a $2,000 or $5,000 account over and over and over again all day long. So we won't be able to trade $5,000 positions, the full value of our account, every single trade for 50 trades in a day, which sometimes we do do in the small cap realm. So this is still up for we don't know yet. It's still up in the air. We don't know yet if the PDT, once the PDT rule is gone, if we will get the settlement margin. And I think the settlement margin is necessary if we're going to see a huge influx of volume in small caps, because then we'll be able to have a lot of people be able to trade an infinite amount of times with their full account. And even though they have a $2,000 account, with these stocks that can go 100 or 200% in minutes, we just had a mover last month, 1,000%. I think we had 5,000. We had a 5,000% move, I think, 2 months ago. So with moves like that on a $2,000 account, you can grow your account so fast, especially when you get that settlement margin. It's pretty much necessary if you're going to do that. So, it's looking good. It's passing through these regulatory agencies. It's getting approved by Finra. Still needs to get approved by the SEC, but it's looking good. It's looking good. I think it's going to have a positive effect on the market, especially on small caps, because the small caps, we have such small supply, and it's going to increase the relative demand because now these small accounts are going to be able to trade, hopefully, as much as possible on very, very volatile stocks. So whether or not this will be good for the new traders that are getting in, the beginner day traders and the small accounts, we don't know yet. I think that it seems like they want, my theory is they don't want to blow up people's accounts, because brokers and market makers profit off of more and more volume. They profit off of volume, because even though you're trading through a commission-free broker, the broker's making money off of payment for order flow, and the market maker's making money off the spread. So the more we're churning volume, even on a free commission broker, on Robinhood, on Charles Schwab, Webull, the whole industry is making money. Whether or not you're making money or losing money, the broker's still making money and the market maker's still making money. So it benefits them for the more people to stay in the game. So, I know some people say that, they're lowering these barriers because they just want people to blow up, and these new accounts, we don't even care about these new traders. They just want their money and just blow up. Yeah, they want their money, but it's also beneficial to keep those people in the game too, because once they're down and out, once they lose their account, then they're done churning volume, and the market maker just lost one more contributor that's paying a couple cents every single trade. The broker's losing money on some payment for order flow, on mass amounts of people. That can add up to a lot of money. So we'll see. It's looking good for these changes. I will update you guys on the vote from the SEC, hopefully soon. But again, these industries, they move so freaking slow. There's probably so much paperwork and so many things that they got to do to make this happen, and it's going to take probably a long time. And especially even on the broker level, even the brokers need to change a lot of their policy, their terms and conditions, and all of this stuff. They've got to change their platforms to be able to account for this new rule. So there's going to be a lot of changes. So I'm not anticipating this to happen this year in 2025. This is probably going to be a 2026 thing. So, just keep that in mind. I will keep you guys updated on any future changes, and I'll see you guys later. Thanks for watching.